Most people feel choosing the right systematic investment plan in investments will eventually give them returns. But do you know what? There is this particular factor which will eventually make people to remove their money from their systematic investment plans with time. And do you know what? This is what breaks your long-term investment when it comes to compounding. By the end of this video, I guarantee you, you will understand why time is the most important factor when it comes to multiplication of your money. But it takes a lot of patience, grit, and commitment. Hi, this is Anirudh Bellari here. Welcome to the 47th video of Your Best Financial Life series. See, in today's video, you will be understanding that why it is that when you invest, especially in systematic investment plans for over a decade, it will eventually start benefiting you. But remember, my friend, this is a game of discipline, as I mentioned you, and there is no guaranteed return whether you will make X amount of returns and all that. But do you know what? With time in your favor, if you are a student who is actually committed to putting a portion of your money to your systematic investment plan without looking at it for the next 10 years, you know what? Your small seed which you planted will eventually grow in size. As a result, it will help you fulfill most of your financial goals. Let's move on to the most important point here on why this happens. See, there are a lot of people who get a lot of emotions when it comes to investing. Now see, as I'll write it down here, it's not a kind of point, but see, emotional investing. Now, what is the meaning of this word emotional investing? It's nothing but you invest your money based on some friend who has told you that this particular, say, mutual fund or stock or whatever is going to do well. Now see, remember, I'm not a finance advisor over here. Please do your own research before doing all these finance related decisions for your life. Now see, for my life, I started my investing journey in 2022 August, and from that time till now, whatever returns I have made in my portfolio has eventually had a lot of difference with time. But do you know what? Because of geopolitical issues, there are a lot of fluctuations and volatility in terms of my percentage results. But do you know what? Having a look at this, it should just give you the motivation to do more of investing. Now see, why did I mention this term emotional investing? INV is nothing but emotional investing. Now see, when a human, he or she goes to an office or a business and earns that particular amount of money, and when you actually address that you keep 10 or 20% of your money for your systematic investment plans or for any kind of investments, it becomes important that you choose the right particular type of time you are going to give to that fund. So how many of you thought that I was going to tell fund? Now see, it's not about fund or time. As I mentioned in the start, why time is going to be eventually important is, see, as I've told you, and I'll repeat this again, see, this is just a learning story. One of my grandfather, my grandfather, he eventually started putting 1,000 rupees, 2,000 rupees. This was when 1999. Say for example, this is just an example. Now from 1999, he kept on putting that 2,000 rupees. You would have heard a lot of stories that who is going to wait from 1999 to 2049, which is like so many years. What is this? Almost 50 years. Now in 50 years, this 2,000 would have become X amount of money and all. See, these are a lot of things which are actually shown in reality. But the process I'm going to tell you is why time becomes important is because with all the curves and volatility which the market cycles go through when it comes to investments, your time is what will make returns over returns. As I've mentioned in my previous videos, say for example, why does this concept turn out to be true in the long run? Now, first of all, you have your taxation, your long-term capital gains tax and all of that. In spite of all that, see, when your 2000 rupees actually works for itself and it gets an additional, say for example, what? 10%. Now what is 10% on 2000, which is 200 rupees. Now say for example, your whatever fund you chose has given you 10% in that particular, say for example, 3 years, for example. Now your 2000 rupees has worked hard for you and got that 200 rupees. Now over a period of time, what happens? This I said was 3 years. In 3 years, you made this 10% returns. Now on this 200 rupees, which is added to your initial amount, which is 2000, you get an amount of 2200 rupees. Now with this, say another 10% is made by this particular fund or whatever. What is 10% of 2200? Whatever the amount. Say for example, what was the amount? Okay, say now eventually what happens is, see, this is where I have told you in the past the staircase concept. What is the staircase concept? Is whereby once you climb the staircase, you eventually go to the next staircase. Very easy to understand, right? But when you leave a staircase behind is where you actually start reaching your particular goal. Now in this case, what happens when money starts to make money? There are a lot of times when people, they choose to withdraw their SIPs, or you can say because of any disaster or whatever has happened and they require that money. And that is where the initial mistake starts. Now see, I'll give you an example of this video which I am giving it to you right now. Now whenever you're going to get this video in June, you will understand that this video, say for example, it has very less views. It's okay, it's not a problem. But when it comes to actually making YouTube videos, there is this concept, the same with compounding, that eventually when you start, your first year, your second year, your third year will show you very less results. Your results will be somewhere, say for example like this. There will be a time when all factors align well, and when you say for example the economy starts recovering from all the type of, you can say, the geopolitical issues and whatever, and as a result your Nifty 50 and your Sensex or whatever, it starts to recover. So your pool of stocks also start recovering, and there will be a curve which will start moving upwards, which will eventually start making returns for you. The same thing with YouTube videos. Eventually the curve will keep on fluctuating this way, and there will be a time where any particular video will eventually start giving returns. This is where the concept of asymmetric returns becomes important. Now see, when it comes to, say for example, fixed deposits, I'm not taking any wrong understanding and meaning over here, but with fixed deposits, what happens? Say for example, for you to get that particular 8% of, say for example, 8% of return or whatever you get. Now see, I'm not guaranteeing any results, but say for example, your fixed deposits has given you returns here. Then eventually 1 year your returns come here. And your inflation itself is at that peak of time whereby it removes your actual growth of returns. As a result, what happens? You may feel that your money is growing, but in reality, it is growing very slowly. And getting asymmetric returns is very difficult. Now, what do I mean by this word over here? Asymmetric. I mean, no need to write this down, but okay, I'll just write it down. I'm sorry if the handwriting or the wording spelling is incorrect. Now see, Asymmetric is you cannot calculate the amount of growth it can give. Now, as I mentioned, why time becomes the most important, I have told you about this. But do you know what? Say, for example, before the COVID-19 crash, there was some person who actually started their investment journey. And say, for example, that person named X, person's name is X, he had invested 50,000 rupees in 2019 start. So he also must have come across a video, or he would have spoken to his financial advisor, and nobody would have expected the COVID-19 crash over there. Now this 50,000, by the time it was say Jan 2020, this 50,000 would have easily halved. What is halved? Your 50,000 would have become anywhere around 25,000 or whatever. See, I might be wrong here, but say for example the 50,000 halved because all the businesses in real life. See, what is a stock? A stock is nothing but a portion of a business. Now, when you buy a portion of a business, and when it comes to your systematic investment plans, you usually put an amount of money to those active managers, like any example of a mutual fund where they buy or sell companies on your behalf. As a result, they charge a consultation fee. This is what happens. Now, when the crash had happened, say all the businesses were not able to perform well because there was lockdowns. As a result, your stock price would have, not stock price, your investment account would have fallen by half. Now, you know what? This 25,000, when you actually open your investment portfolio and see, this is what will give you that shock. Now, see, I believe in this concept that if an investment does not allow you to sleep peacefully at night, then you know what? You should not be invested. Why? Because eventually, whatever money you are earning, whether you invest it or you spend it, it should eventually make you feel happy. If that happiness itself is not there because your emotions are high, your emotional intelligence is less, then my friend, it will be very difficult for you to actually see these asymmetric returns. Because understand, if you do what others are doing, and expect a different result every time, and I'm sorry to say, my friend, it is very difficult to expect returns. As I mentioned, if you feel that the amount of 50,000 had halved had become 25,000 and you eventually remove this amount and you come with a conclusion saying, I will no more invest, then my friend, it is a mistake from your end. Because remember, there are two sides of a coin. A coin always has a heads and tails. You know what? In this type of scenario, usually that particular investor would have seen the tail side of investment. But to see the head side of investment, for the market to actually recover, it would have easily taken around 2 years. Now, for people who actually waited 2 to 3 to 4 years, they would have seen their 25,000 rebound and broken their 50,000 height. Now, why does this happen? Now, see, when businesses, they stop doing well because of any political issue or any geopolitical issue, and when they actually recover, that recovery is the time when maximum returns are made. Now, see, there could be many examples here. I will not be quoting any example, but you only think. I'll give you a very fair example. In your life, say for example, you had an airline fracture, or you can say you had a fracture on your hand or whatever while playing any sport. Now, after in that 1 year or say 6 months, when you were at bed rest, you were not allowed to actually play that sport. And the second year, when your hand became recovered and you actually started playing, when you get the hang of it, your recovery time and all that waiting time which got accumulated to heal your hairline or your hand would have eventually started to benefit you when you played the sport in the second year. Because bouncing back is what is an art of every individual and human being, whether it comes to investments and time. See, time always will test your patience. And remember, if you keep thinking that SIPs will eventually make you a multi-millionaire, the answer is time. Returns cannot be guaranteed. The principal amount you put, depending on your financial condition, becomes important. But the time is in your hand. As I mentioned this concept over here, P stands for principal. Principal amount is your capital amount which you put. Say for example, a person is putting 50,000 rupees every month. Your rate of investment, what your particular systematic investment plan will eventually give you, cannot be identified. Why? Because there will be times when your SIPs will perform comparatively well in the present year compared to the past, and there will be upturns also. Because remember, your markets always move in cycles, and this is the biggest learning I got in my life. And this is why I want to share this concept with you. So returns can be a question mark, whereby you may not know how much returns you can expect. But the only thing in your hand over here is time. The capital also is in your hand, but capital also depends on your earning and how much you want to invest in that particular systematic investment plan or mutual fund or any stock or whatever. But time is where you have a control of. If you utilize this time pretty well by understanding that your personal life can actually be compounded when you make time for yourself and those skills which can eventually help you to get a lot of returns when it comes to your money and your active income, your day-to-day work, where you can earn a lot of money, and a portion of that can work without you actually maintaining and seeing your time in your portfolio, and that is why it becomes important. Now say, as I mentioned here, a person who has seen only the tail side of portfolio, whereby he or she had invested before the COVID crash, that person would have come out with a conclusion that investments are not meant for her or him. But if there was a person who actually invested in the year 2010, and as I was mentioning you, my granddad, he had invested in 1999. Now say example, okay, there is somebody else whose name is Y, and that person invested in 2010 till 2020. He was investing with all patience, commitment, grit, and moment the COVID crash hit, his investments of, say for example, his corpus was 30 lakh rupees. His 30 lakh rupees had become 28 lakh rupees because of the COVID crash. Now see, for any normal human being, if you keep investing for 10 years and then you say, what is this here? My money is not at all grown. And then you remove this. That is the biggest blunder you can do for your life. Because remember, if for 10 years, if for those 9 years, your investments perform decent, and it is because of the COVID crash that your returns have gone in negative. And if you reverse your psychology, you will understand that when the recovery happens, that is the time when all the returns of your 10 years will eventually come at 2 years short. Now, what do I mean by this? I mean to tell that the 10 years gap which you waited, and when the recovery starts, the 10 years effect will be shown in 2 years. Now see, the friend Y of mine, say for example, one scenario was he removed these 28 lakhs. The second scenario was he left the 28 lakhs. He was not bothered, or he just left it. within the next 4 years till 2024 from 2020, his investments easily tripled. His 30 lakh had gone to 90 lakh. Do you know why? Because the effort, the weight lifting, the hard lifting is done by time only after 10 years. And that is why 10 years is a very long period of time, my friend. Whether it is a child's birth from the age of 0 to 10, or whether it is starting your particular business from 0 to 10 years, or to actually work in that particular company as an employee from 0 to 10 years is a very, very big thing. And for you to understand that your investments is also like a small child that will actually start from year 0 and go to year 10, but only with that mindset that you won't be removing it. If you have this type of self-discipline whereby you can wait and you can maintain your lifestyle at a decent level without interrupting the growth of your systematic investment plans, then do you know what, my friend? Time will be the best answer for you, whether it is returns or whether it is the amount you have manifested for all your financial goals. Time will make it true. But also remember, it is the amount of capital you also put in which will actually help you to understand what type of returns and the faster rate of money which could grow with period of time. That's why remember, there is a saying, investment is always a regret game. I'll write it down for you, just a second. See, as I mentioned here, there is a saying, investment is always a regret game. Now, what do I mean by this? Investments is always a regret game. See, for someone who has been waiting from the year 2010, waiting as in by keeping on investing, and while this person Y was talking to his friend would have been like, he or she would have earned anywhere around 2x to 3x returns in any particular stock, or you can say gold or silver or whatever be the scenario at that moment of time. Then this person Y would eventually start to question himself by asking that from 2010 till today I've been investing. Why isn't there any returns? This with scenario before the COVID crash. Always remember, as I mentioned, this investing is always a regret game. Any friend or peer of yours can tell you beautiful stories that he or she would have made this amount of returns or that particular thing, or they would have bought this particular vehicle because of their investment returns. But do you know what? It is eventually the time which will decide the fate of any investment. That is why what type of fund you put could be an importance, but the most important importance over here is with time. That's why I've been telling this concept again and again, that time will do the heavy weight lifting. It's this exact same concept with this YouTube video as well. Right now in the year 2026, how many ever of you have been seeing this video? It's very good. I mean, I don't mind if this video has even 0 views or 10 views or whatever. But if you are in the year 2032 watching this video with at least say 40,000 views or whatever, then remember, my friend, it is the time which has helped me to grow at this stage. It is not because I have paid and promoted this video. Let's move on to the next and final most important point. See, the fear over here with people to actually remove or to change their investing style or fund is, the only fear you have is, what if I lose my money? The what if question. Now see, to address this what if question is where the actual answer comes, when you actually start expecting realistic returns. Now what is realistic returns? anywhere between 12 to 15 percentage of returns with the advice of your financial advisor. If you actually go through this way and you see the pros and cons with your financial advisor and all of that, it gives you clarity. See, a lot of clarity is what eliminates your fear. Now, say for example, somebody is new at swimming. What is the fear in the brain? The brain would be like, what if I drown in this 4 feet pool? But the actual reality is, if you have an experienced swimmer who handholds you and is ready to guide you, then the fear will slowly start eliminating, because when you do something is when you actually start learning, and when you give time, commitment and consistency is when you become better version of yourself, whether it is swimming or whether it's your investments or whether it is for me as well for this video. There are a lot of understandings in this, and whether it could be you as well, whether it's in your business. Just think about it. 10 years ago, how you used to be a businessman, and today, how you are as a businessman. There is 100% a drastic change, whether it is your body language, your personality, your dressing sense, your communication style, your relationship making style with people. Everything becomes very important in any business, right? The same goes with me as well. Say, for example, right now when I'm shooting this video, these are my clothes, this is how I'm speaking and all of that. But 10 years down the line, there will be some change, right? That's how any human being grows. And that is the same with your investments as well. That is the reason you keep giving your best and leave the rest. It's very easy for me to say, but for you to actually follow this, be very, very hard working. But remember, this is a game of leverage. Now, what is leverage? Leverage is nothing but other people's time and money. Now, what is other people's time and money? You have invested, say, that 50,000 rupees, and there are a lot of people who have chosen the same fund or stock and they also invest in the same. With time, what happens? With time, a lot of more people put their money, and eventually, because of demand supply, that particular stock, mutual fund or systematic investment plans, according to the volatility and all of that, it keeps fluctuating with time. The same thing, not in supply demand, but with a human body as well. Now you'll be thinking, how human body? What is this leverage? See, if a person knows how to do business by using other people's time and other people's money, it's bonus, but comes with a lot of risk. Now see, for all this information, knowledge or whatever you may call it, I've given for the, 20-25 minutes. If you really found this worth and valuable, you can do share it to a lot of people, because I do feel there are a lot of people out there who fall in the category of, not understanding whether it's investments or finances, and I do want to make a difference in the society by me coming out on camera and teaching this concept for you. Thank you so much once again for your precious time, and I really respect your time that you have given for this video. Thank you so much once again.